Most of the U.S. apartment market saw a nice bump in second quarter, but not Southern California. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons, and I'm joined today with Greg Willett, the Yoda of apartment market research. And Greg, of the 64 core metros tracked by MPF Research, only 14 recorded occupancy loss in 2Q. And 4 of those 14 are located in Southern California. Let's look at this chart here. Occupancy dropped 0.7 percentage points in San Diego. It's down 0.4 points in Ventura and Los Angeles, down 0.2 in Orange County, and Riverside's the exception, up a half a point. And then we look at rent change. Rent growth was pretty muted in this area compared to the national norm. We look at this chart here, we see some very mild numbers here. So Greg, what went wrong in Southern California this past quarter?
Well, ignoring the Yoda reference, I will talk about Southern California and focus in, as usual, on the job stats first. They really don't look that different when you compare Southern California with the rest of the nation. We're seeing a little bit of growth in the first half of the year, nothing spectacular. But I will point out that Southern California is an area that tends to get some really big revisions from the initial estimates to the final numbers. So it wouldn't surprise me if, in fact, there's some trailing in the economy there, and really you would kind of expect that when you look at the nature of Southern California's economy. Very focused on consumer spending and on the housing markets, and we certainly know that those are sectors that are not doing well at this point.
Absolutely. And let me ask you about one particular thing in California, and that's their state government, which has had some very unique and deep problems. You know, have those factors trickled down at all the apartment market or other issues at play here?
You are seeing some layoffs in the government sector all across California at this point. Some really deep ones on some of the local governments. And obviously that has a short-term impact. I would really say that the big issue is look at the long-term influence, and the question that we really don't know now is whether or not this will impact just general quality of life issues in Southern California and really kind of change its role in the national dynamic.
And Greg, taking a step back here, I should be pointing out that while 2Q specifically did not bring some good news for Southern California in the apartment market, every Southern California metro did record occupancy growth in the year ending June, and overall occupancy rates do remain pretty solid here. So given that, do you see 2Q as a blip or a sign of struggle coming ahead?
As we look at the numbers over the course of the past year, Southern California really did show some momentum really during 2009, and it has just kind of tapered off and plateaued as we've got into 2010. And I really think the reason behind that is we were having some big rent cuts earlier that were helping to generate some demand, and we've really done what we can with what we have to work with in that market at this point. So until we actually get some more jobs going, I think there's probably some tendency to flatline.
And let me ask you about one metro in particular, the Riverside Inland Empire area. As we mentioned earlier, this was the one market that recorded occupancy growth in 2Q, up a half a point, and occupancy is up 3 points annually. Do you see any reasons why this one stands out? As
you look at the Inland Empire, the Riverside area, unlike the rest of Southern California, the cost to buy and to rent housing are pretty comparable in that area. Actually, at this point, with the big corrections in the single-family market, it's actually cheaper to buy than to rent in that area. So it is a place where the price dynamics, as you adjust the pricing, you can have big trade-offs in the demand from one housing type to another.
And one last question for you, Greg. As we look ahead, going forward, which of these metros do you see best positioned to record revenue growth in the next couple of years, and which is most likely to struggle, if any of them?
Certainly our favorite in the group is going to be San Diego. It has a little bit of a different economic structure than the rest of the region. I was talking about the focus on consumer spending and housing. In San Diego, you have the military influence, you have some high-tech employment, you have some biomedical employment. I think just the overall economy is going to do better in San Diego than in the rest of the region, so that would be the standout. Certainly on the negative side, the Inland Empire is going to have some challenges, again, because of what's happened in the single-family market. As you look at LA and Orange County and to some degree Ventura, those are probably the question mark markets because you really don't know what's going to happen with the economies in those areas.
Thank you, Yoda. That wraps us up for Southern California. So until next time, for Greg Willett and MPF Research, I'm Jay Parsons. Thanks for watching Apartment Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.